Hello and welcome. If you're listening to this, chances are you're familiar with a certain kind of weight. It's the weight of unopened envelopes from the Internal Revenue Service. It's the stress that comes with a tax debt that feels insurmountable. You may have seen late-night commercials or online ads promising to erase your tax debt for pennies on the dollar. They flash impressive numbers and talk about government-approved programs that sound too good to be true. This leaves you with a critical question. Are these IRS tax forgiveness programs real? The short answer is yes and no. The idea of the IRS simply wiping your slate clean with no questions asked is a myth. But the reality is that the IRS does have several official, legally established programs designed to help taxpayers who are in genuine financial hardship resolve their tax liabilities. This series is your guide to understanding those programs. We will take an honest, no-hype look at what they are, who qualifies, and what the process actually involves. Before we dive in, it is absolutely critical to state the following. The information provided in this audio series is for educational and informational purposes only. It is not legal, financial, or tax advice. Every individual's tax situation is unique and complex. You should always consult with a qualified and credentialed tax professional, such as a certified public accountant, an enrolled agent, or a tax attorney, to discuss your specific circumstances. This series is designed to empower you with knowledge, so you can ask the right questions and better understand the options a professional might present to you. So let's start by reframing the term, tax forgiveness. While it's a popular marketing phrase, the IRS doesn't use it. Instead, they talk about tax relief or collection alternatives. This is a crucial distinction. Forgiveness implies your debt simply vanishes. Relief implies a structured process to make the debt more manageable or, in specific cases, to reduce the amount the IRS will agree to collect. Why would the IRS ever agree to take less than what they are owed? It's a matter of practicality. The IRS's primary mission is to collect taxes to fund the government. They recognize that sometimes a taxpayer's financial situation is so severe that attempting to collect the full amount is impossible and counterproductive. Pushing an individual or a business into bankruptcy doesn't help anyone. It's often more efficient for the IRS to collect what is realistically possible rather than spend resources chasing a debt that will never be fully paid. These relief programs are their mechanism for making that determination in a formal, structured way. Think of it as a system with strict rules of engagement. These are not loopholes or secret tricks. They are clearly defined programs with extensive application processes, detailed financial disclosures, and rigorous reviews by the IRS. The companies that advertise heavily are essentially offering to help you navigate this complex bureaucracy, for a fee, of course. Over the course of this series, we will break down the main pillars of IRS tax relief. We'll explore the Offer in Compromise, or OIC, which is the program most people think of when they hear pennies on the dollar. We will dedicate significant time to this, as it is the most sought after, but also one of the most difficult programs to qualify for. We will also cover installment agreements, which allow you to make monthly payments over time. We'll look at the different types, from simple agreements for smaller debts to more complex ones for larger liabilities. Another key topic will be currently not collectible, or CNC status. This is a temporary solution for those experiencing severe financial hardship where the IRS agrees to pause collection activities. It's not forgiveness, but it can provide critical breathing room. We will also discuss options like penalty abatement, where you can request that the IRS remove certain penalties if you have a valid reason, and we'll touch on the protections offered by bankruptcy. In this first chapter, our goal is to set the stage. It's to move past the marketing hype and establish a foundation based on reality. The reality is that resolving a significant tax debt is a serious financial process. It requires organization, honesty, and a complete picture of your financial life. There are no magic wands. But for those who genuinely cannot afford to pay their tax debt in full, there are real, legitimate pathways to resolution. Understanding these pathways is the first and most powerful step you can take towards lifting that weight and finding a way forward. Join us in the next chapter, as we begin our deep dive into the most famous and misunderstood of all IRS programs, the Offer in Compromise. We will explore what it truly means to settle your tax debt for less than you owe. Welcome back. In our last chapter, we set the stage, separating the marketing myths from the structured reality of IRS tax relief programs. Now we dive into the one program that fuels more hope and more misconceptions than any other, the Offer in Compromise, or OIC. This is the program behind those pennies on the dollar advertisements. But what is it really? And what does it take to actually qualify? An offer in compromise is a formal agreement between a taxpayer and the IRS that resolves the taxpayer's tax liability for less than the full amount owed. Let that sink in. It is a formal, legally binding agreement. This is not a casual negotiation. It is a rigorous process where you, the taxpayer, must convince the IRS that accepting your offer is their best and final chance to collect anything on your account. Before you can even submit an offer, you have to meet some basic eligibility requirements. First, you must have filed all required tax returns. The IRS won't even consider an offer from someone who is not in compliance with their filing obligations. Second, you must have received a bill for at least one tax debt included in the offer. And third, you must be current with all tax payments for the current year, including making any required estimated tax payments and payroll tax deposits if you are a business owner. If you fail to meet these initial hurdles, your offer will be immediately returned without even being considered. Now, assuming you meet those basic requirements, we get to the heart of the OIC program. The IRS will only accept an offer in compromise if you can prove one of three specific circumstances. The most common of these is called doubt as to collectability. This is the foundation of nearly all successful OICs. It means that you are demonstrating, with extensive financial proof, that you do not have the income or assets to pay your tax debt in full, now or in the foreseeable future. The IRS is not making a judgment on whether you are a good person. They are making a cold, calculated financial decision based on a formula. This formula is called your Reasonable Collection Potential, or RCP. Understanding this concept is the single most important part of understanding the OIC. Your RCP is the number the IRS calculates to determine what it can realistically expect to collect from you. It's a combination of the net value of your assets, things like your house, car, bank accounts, and investments, after subtracting any loans against them, plus your future income potential. To calculate your future income potential, the IRS looks at your monthly income, subtracts your necessary living expenses based on strict national and local standards, and then multiplies that remaining amount by a number of months into the future. The final number they arrive at is your RCP. Your offer amount must meet or exceed this number. So when you hear pennies on the dollar, it doesn't mean you get to pick a low number you feel is fair. It means that for some people in dire financial straits, their calculated reasonable collection potential is, in fact, only a fraction of their total tax debt. For them, a settlement of pennies on the dollar is possible because the IRS formula itself determined that was all they could ever hope to collect. The other two, much rarer, grounds for an OIC are doubt as to liability and effective tax administration. Doubt as to liability means you are arguing that you don't actually owe the tax in the first place, that there was a legitimate mistake in the assessment. This isn't about ability to pay, it's about the validity of the debt itself. Effective tax administration is for cases where there is no doubt you owe the tax and you have the ability to pay, but an exceptional circumstance, like a serious long-term illness, would make collecting the full amount unjust or create an economic hardship. These cases are extremely uncommon. Submitting an OIC is an exhaustive process. It requires completing detailed financial statements, providing bank records, pay stubs, vehicle titles, property deeds, loan statements, and more. You are essentially opening your entire financial life to IRS scrutiny. And while the offer is being considered, which can take many months, the IRS's 10-year statute of limitations for collecting the tax is paused. The hard truth is that the IRS accepts a minority of the OICs submitted. Many are rejected because the taxpayer's RCP was higher than their offer, or because the application was incomplete. This is not a simple path. It is a last resort for taxpayers facing genuine, demonstrable financial hardship. In our next chapter, we will break down the reasonable collection potential formula in greater detail. We'll explore how the IRS values your assets and what qualifies as an allowable living expense in their eyes, which is often very different from your actual monthly budget. Welcome back. In our last chapter, we introduced the offer in compromise, or OIC, as the IRS's formal process for potentially settling a tax debt for less than the full amount. We established that your eligibility hinges almost entirely on a single number, your reasonable collection potential, or RCP. This is the figure the IRS calculates to determine the absolute minimum offer they will even consider. Today, we're pulling back the curtain on how that number is calculated. As always, let's begin with our important reminder. This information is for educational purposes only and is not tax, legal, or financial advice. The calculations we are about to discuss are simplified for clarity. The actual process is highly detailed, and a qualified tax professional is essential for navigating it correctly. Our goal here is to help you understand the logic the IRS uses. The reasonable collection potential formula is essentially made up of two key components. First, the net value of your assets, and second, a portion of your future income. Let's break these down one by one. First, let's talk about your assets. The IRS requires a complete and honest accounting of everything you own. This includes cash on hand, money in checking and savings accounts, investment and retirement accounts, the value of your home, your cars, and any other real estate or valuable property. For most of these assets, the IRS isn't interested in the full market value. Instead, they use what's called a quick sale value, or QSV. The quick sale value is typically about 80% of the asset's fair market value. The logic behind this is that the IRS is calculating what they could get for your asset if they had to seize it and sell it quickly. After determining the QSV, they then subtract any loans or liens against that asset. The remaining amount is called the net realizable value. Let's use a simple example. Say you own a car with a fair market value of $10,000. The IRS would first calculate the quick sale value, which at 80% would be $8,000. Now let's say you still have a $6,000 loan on that car. The IRS would subtract that $6,000 loan from the $8,000 QSV. The resulting $2,000 is the net realizable value of your car, and that is the amount that goes into your RCP calculation. They perform the same basic calculation for your home, investments, and other significant assets. The second component of the RCP formula is your future income. This is where things get even more complex. The IRS wants to determine how much money you will have left over each month after paying for basic necessities. This leftover amount is called your net disposable income. To calculate this, they start with your gross monthly income, and then subtract allowable monthly expenses. And this is a critical point. The IRS's definition of an allowable expense is not the same as your actual household budget. The IRS uses a set of national and local standards for core living expenses. These include categories like food, housekeeping supplies, apparel, personal care, and housing and utilities. For housing and transportation ownership costs, they will often look at local standards or your actual expenses, whichever is lower. What does this mean in practice? It means that even if you spend $800 a month on groceries for your family, if the IRS national standard for a family of your size is $650, they will only allow you to deduct $650 in your calculation, unless you can provide extraordinary proof for the higher expense. The same applies to car payments, rent, and other costs. This is one of the biggest hurdles for taxpayers. The IRS's standardized budget is often much leaner than how most people actually live. Once they have determined your net disposable income by subtracting these allowable expenses from your monthly income, they multiply that number by a set number of months to project its value into the future. Typically, this is either 12 months or 24 months, depending on the payment terms of the offer you propose. We will discuss those payment terms in a future chapter. So, the final reasonable collection potential formula looks like this. The net realizable value of your assets is added to your monthly net disposable income multiplied by either 12 or 24. That final number is your RCP. Your offer to the IRS must be equal to, or greater than, that calculated amount. This process reveals that an OIC is not a negotiation based on what feels fair. It is a rigid mathematical assessment of your financial past, present, and future. In our next chapter, we will explore the different payment options for an offer in compromise and discuss what happens after you submit your offer package to the IRS. Welcome back to our honest look at IRS tax relief. In our last chapter, we dissected the IRS's formula for the reasonable collection potential, or RCP, breaking down how they value your assets and calculate your future income. Knowing your RCP tells you what you need to offer. Today, we're focusing on the next critical questions. How do you propose to pay that offer, and what exactly happens after you send your application package to the IRS? As we begin, please remember our standard disclaimer. This content is for educational purposes only. It is not a substitute for professional tax advice. The decision between payment options has significant financial implications and should be made only after consulting with a qualified tax professional who can analyze your specific situation. When you submit an offer in compromise, you generally have two ways to structure the payment: the lump sum cash offer and the periodic payment offer. The choice you make directly impacts the calculation of your reasonable collection potential that we just discussed. Let's start with the lump sum cash offer. This might sound like you need to pay the entire amount in a single check, but the name is a bit misleading. This option requires you to pay the offer amount in 5 or fewer installments within 5 months after the IRS formally accepts your offer. The key advantage here relates to the RCP formula. When you choose the lump sum option, the IRS calculates the future income portion of your RCP by taking your monthly net disposable income and multiplying it by 12. This generally results in a lower total RCP and therefore a lower potential offer amount. However, this option comes with a significant upfront requirement. You must send a non-refundable payment of 20% of your total offer amount with your application. If the IRS rejects your offer, you do not get this money back. The second option is the periodic payment offer. This option allows you to pay the offer amount in monthly installments over a longer period, typically from 6 to 24 months after the offer is accepted. The trade-off for these extended payment terms is a higher total offer amount. With this option, the IRS calculates the future income portion of your RCP by taking your monthly net disposable income and multiplying it by 24, effectively doubling that part of the formula compared to the lump sum offer. For this option, you must submit the first proposed monthly payment with your application. You are also required to continue making these monthly payments while the IRS is evaluating your offer. Just like the lump sum down payment, these payments are also non-refundable if your offer is ultimately rejected. Once you've chosen your payment option and submitted the extensive paperwork, your file enters the IRS review process. First, it's checked for basic completeness. If you've forgotten a form or failed to meet the basic eligibility we discussed in Chapter 2, it will be returned immediately. If it passes this initial check, it is assigned to an IRS offer specialist or examiner. This examiner's job is to act as a financial detective. They will scrutinize every single number you provided on your financial statements. They will ask for months of bank statements, pay stubs, proof of all your expenses, and documentation for any asset you own. They will verify car and home values using public records. Their goal is to confirm that your calculated RCP is accurate and that you have been completely transparent. If they find discrepancies, they will challenge them. After this exhaustive review, there are 3 primary outcomes. The best case is acceptance. You'll receive a letter confirming the agreement, and you must then pay the offer as agreed. The second outcome is rejection. The IRS will send a letter explaining why your offer was denied. You typically have 30 days to appeal this decision. The third outcome is a returned offer. This can happen if the examiner determines you have the ability to pay the debt in full through an installment agreement or by liquidating assets. Finally, it is crucial to understand that an accepted offer in compromise is not the end of the story. It is a conditional agreement. For 5 years after your offer is accepted, you must remain in full tax compliance. This means you must file all required tax returns on time and pay all new taxes in full and on time. If you fail to meet these terms during this 5-year probationary period, the IRS can void the agreement, and your entire original tax debt, minus what you've already paid, can be reinstated with interest and penalties. This is the most important string attached to any OIC. In our next chapter, we will shift our focus. What if an offer in compromise isn't the right fit? We will explore a much more common and accessible form of tax relief, the IRS installment agreement. Welcome back. In our previous chapters, we took a deep dive into the complex world of the offer in compromise. We learned that while it can be a powerful tool, it is a difficult path reserved for those in the most severe financial hardship. So, what about everyone else? What if you fully intend to pay your tax debt, but you simply cannot pay it all at once? For millions of taxpayers, the answer is an installment agreement. This is perhaps the most common and straightforward of all IRS tax relief options. An installment agreement, or IA, is a formal arrangement with the IRS that allows you to make monthly payments for a set period until your tax debt is paid in full. Unlike an offer in compromise, an installment agreement does not reduce the amount of tax you owe. Instead, it gives you a structured and manageable way to pay the full debt over time. As always, we must begin with our crucial reminder. The following information is for educational purposes and should not be considered tax or financial advice. The specifics of installment agreements can vary, and consulting with a qualified tax professional is the best way to determine the right course of action for your individual situation. The beauty of the installment agreement lies in its accessibility. The qualification requirements are far less stringent than for an OIC. The primary factor is the total amount you owe. For taxpayers who owe a combined total of under $50,000, which includes tax, penalties, and interest, there is often a streamlined process to apply for an agreement online. The IRS is generally willing to grant these agreements as long as you have filed all your required tax returns. There are several types of installment agreements, but let's focus on the most common ones. First is the guaranteed installment agreement. You are statutorily guaranteed an agreement if you meet certain criteria. You owe $10,000 or less in tax only, not including penalties and interest. You agree to pay the balance in full within 3 years. You have a perfect compliance record for the past 5 years, and you can demonstrate that you cannot pay the full amount immediately. More common is the streamlined installment agreement. This is for taxpayers whose total liability is $50,000 or less. These agreements can typically extend up to 72 months or 6 years, and often do not require the submission of a detailed financial statement. This makes the application process significantly simpler and faster than the exhaustive review required for an OIC. For those who owe more than $50,000, setting up an agreement is still possible, but it usually requires more documentation. You will likely need to complete a financial statement, similar to the one used for an OIC, to prove to the IRS that your proposed monthly payment is the most you can reasonably afford. It's important to understand that an installment agreement does not stop penalties and interest from accruing. While your account is in good standing, penalties may be reduced, but interest will continue to be charged on your outstanding balance until it is paid in full. Think of it like a loan. You are paying off the principal, but interest keeps adding up. Because of this, it is always in your best interest to make the highest monthly payment you can comfortably afford to clear the debt as quickly as possible. Setting up an installment agreement provides a critical benefit. It stops most IRS collection actions. Once your agreement is approved and you are making your payments on time, the IRS will generally not levy your bank accounts or garnish your wages. It provides peace of mind and a clear path to resolving your debt. However, just like with an OIC, the agreement is conditional. You must stay current on all future tax obligations, filing and paying on time, to keep your agreement in good standing. In our next chapter, we will discuss another important form of temporary relief for those facing extreme financial hardship: being placed in currently not collectible status. Welcome back. In our last chapter, we explored the IRS installment agreement, a practical path for those who can afford to make monthly payments to resolve their tax debt over time. But what happens when your financial situation is so dire that you can't even afford a minimal payment? What if your income doesn't even cover your basic living expenses? In these extreme cases, the IRS has a provision known as currently not collectible, or CNC status. Before we proceed, it is essential to repeat our standard disclaimer. The information in this chapter is for educational purposes only and is not legal or tax advice. CNC status has significant long-term implications, and you should only explore this option with the guidance of a qualified tax professional. Currently not collectible status is exactly what it sounds like. It is a formal declaration by the IRS that, based on your current financial situation, they will not attempt to actively collect the tax you owe. If you are granted CNC status, the IRS will temporarily suspend collection activities. This means they will stop sending threatening letters, and they will cease wage garnishments and bank account levies. For someone facing overwhelming financial pressure, this can provide immediate and critical relief. However, it is absolutely vital to understand what CNC status is not. It is not tax forgiveness. Your tax debt does not go away. In fact, while you are in CNC status, your debt continues to grow. Penalties and interest will continue to accrue on your outstanding balance, making the total amount you owe larger over time. Furthermore, even if your account is placed in CNC status, the IRS may still file a notice of federal tax lien. This is a public claim against your property, which can damage your credit and make it difficult to sell assets or obtain new loans. So who qualifies for this status? CNC is reserved for individuals experiencing true economic hardship. To qualify, you must prove to the IRS that your monthly income is less than your necessary, allowable living expenses. You'll remember from our discussion on the offer in compromise that the IRS uses strict national and local standards to determine what constitutes a necessary expense. You will be required to submit a detailed financial statement, typically Form 433-F, along with supporting documentation like pay stubs and bank statements, to prove your financial situation. The IRS will analyze this information to verify that you truly have no disposable income left at the end of the month to put toward your tax debt. It's also important to know that CNC status is not permanent. The IRS considers it a temporary situation. They will typically review your case every year or two. How do they do this? By looking at the new tax return you file each year. If the income on your return has increased significantly, the IRS will likely remove the CNC status and require you to set up a payment plan, such as an installment agreement. There is one final, complex element to consider: the statute of limitations on collection. The IRS generally has 10 years from the date a tax is assessed to collect it. This is known as the Collection Statute Expiration Date, or CSED. Being placed in CNC status does not typically stop this 10-year clock from ticking. This means that if a person's financial hardship persists for the remainder of that 10-year period, the tax liability could expire, legally unenforceable. This is not a strategy, but rather a potential outcome of the law for those in long-term, severe hardship. In summary, currently not collectible status is a safety net. It provides a temporary pause on collections for those who need it most, but it doesn't solve the underlying debt, which continues to grow. In our next chapter, we'll shift gears to discuss a different type of relief: penalty abatement, a process for potentially removing IRS penalties from your account. Welcome back. So far in our series, we have explored ways to manage the core tax debt you owe through programs like the Offer in Compromise and the Installment Agreement. But for many taxpayers, a significant portion of what they owe isn't the tax itself. It's the penalties that have been added on top. Penalties for filing late or paying late can quickly inflate a manageable debt into a daunting one. The good news is that these penalties are not always set in stone. The process for asking the IRS to remove them is called penalty abatement. As we delve into this topic, it is crucial to remember our guiding principle. This is educational information, not tax advice. The rules surrounding penalty abatement are specific, and successfully navigating them often requires a detailed presentation of your case. Always consult a credentialed tax professional for guidance on your specific circumstances. First, let's be clear about what penalty abatement does and does not do. If granted, it removes specific penalties from your account. It does not remove the original tax you owed, nor does it remove the interest that has accrued on that original tax. However, because interest is also charged on penalties, removing a penalty will also remove any interest that was charged on that penalty, which can provide significant savings. The IRS will consider removing penalties for several reasons, but the vast majority of successful requests fall into two main categories: first-time penalty abatement and reasonable cause. Let's start with the most straightforward one: first-time penalty abatement, often called FTA. This is an administrative waiver that the IRS may grant to taxpayers with a clean compliance history. Think of it as a one-time get-out-of-jail-free card for an honest mistake. To qualify for FTA, you generally must meet three key criteria. First, you must have a history of good compliance, meaning you had no penalties for the 3 years prior to the tax year in which you incurred the penalty. Second, you must have filed all currently required returns or filed a valid extension. And third, you must have paid, or arranged to pay, any tax due. FTA commonly applies to the failure to file, failure to pay, and failure to deposit penalties. It is a powerful tool, and you can often request it with a simple phone call to the IRS. The second and more complex path to penalty removal is arguing reasonable cause. This means you are asserting that despite exercising ordinary business care and prudence, you are unable to file your return or pay your tax on time due to circumstances beyond your control. This is not a simple excuse. It requires a compelling reason backed by credible evidence. So what does the IRS consider reasonable cause? While every case is unique, common examples include a death or serious illness of the taxpayer or an immediate family member that prevented them from managing their affairs. A natural disaster, fire, or civil disturbance that destroyed your home or records could also qualify. Another example is relying on incorrect advice from a competent tax professional, although you must prove your reliance was reasonable. Simply being unaware of the tax law, or not having the funds to pay are generally not considered valid reasons for reasonable cause. The IRS expects you to be aware of your tax obligations, and to file on time, even if you cannot pay on time. To make a successful reasonable cause argument, you must provide a detailed explanation of what happened and when, and supply supporting documentation, such as hospital records, death certificates, or letters from doctors. Requesting penalty abatement can be done in a few ways. For a simple first-time abatement, a phone call might suffice. For a more complex reasonable cause argument, you would typically write a detailed letter to the IRS or file Form 843, which is the official claim for refund and request for abatement. Regardless of the method, the key is a clear, concise, and well-documented explanation of why you believe the penalties should be removed. In our next chapter, we will discuss a very specific but important form of relief designed for individuals who have been burdened by the tax debt of a spouse or former spouse: innocent spouse relief.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Welcome back. In our journey through IRS tax relief, we've covered programs for those who can't pay their debt. But what if the debt isn't truly yours? Imagine this scenario. You signed a joint tax return with your spouse in good faith, only to find out years later, perhaps after a divorce, that your spouse hid income or claimed improper deductions, leaving you legally responsible for a massive tax bill you knew nothing about. For situations like this, the IRS has a specific and crucial set of protections known as innocent spouse relief. As we navigate this complex topic, please remember our essential disclaimer. This is for educational purposes only and is not legal or tax advice. The rules for innocent spouse relief are highly dependent on the specific facts and circumstances of your case. It is vital to consult with a qualified tax professional to understand your rights and options. To understand why this relief is so important, you first need to understand a legal concept called joint and several liability. When you sign a joint tax return, you and your spouse are both held 100% responsible for the accuracy of that return, and for the full amount of the tax, penalties, and interest, regardless of who earned the income. This means the IRS can come after you for the entire debt, even if your spouse was the one who made the error. Innocent spouse relief provides a potential way out of this binding agreement. The term innocent spouse relief is actually an umbrella for three separate types of relief. The first is the one that bears the name, innocent spouse relief. To qualify for this, you must meet several strict tests. You must show that there was an understatement of tax on your joint return caused by erroneous items of your spouse. More importantly, you must establish that when you signed the return, you did not know, and had no reason to know, that there was an understatement of tax. The IRS will look at factors like your education level, your involvement in the family's finances, and whether your spouse was deceptive. Finally, you must show that, considering all the facts and circumstances, it would be unfair to hold you liable for the debt. The second type of relief is separation of liability relief. This form of relief allocates, or divides, the understated tax between you and your spouse, or former spouse. You are then only responsible for the portion allocated to you. To qualify, you must be divorced, legally separated, or have lived apart from your spouse for at least 12 months. Unlike traditional innocent spouse relief, you could have known about the erroneous items when you signed the return, but you can still request to be held responsible only for your share of the debt. The third and final type is equitable relief. This is a kind of safety net for those who don't qualify for the other two forms of relief, but where it would still be fundamentally unfair to collect the tax from them. Equitable relief can apply to situations involving an understatement of tax, like the others, but it can also apply to an underpayment, where the tax was reported correctly on the return, but the bill was never paid. The IRS will consider a wide range of factors, including economic hardship, and whether you were a victim of spousal abuse or financial coercion. Requesting any of these forms of relief is done by filing Form 8857, Request for Innocent Spouse Relief. It is a detailed form that requires you to explain your situation thoroughly. It is crucial to file this form as soon as you become aware of a tax liability that you believe you shouldn't have to pay. When you file the form, the IRS is required to notify your spouse or former spouse, who will have an opportunity to participate in the case. Innocent spouse relief is a powerful but challenging area of tax law. It acknowledges that marriage should not automatically mean a lifetime of liability for the financial misconduct of another. In our next chapter, we will discuss what happens when the IRS denies your request for relief. We will explore the basics of the IRS appeals process. Welcome back. Throughout this series, we've explored various IRS relief programs, from the offer in compromise to innocent spouse relief. For each of these, there is a detailed application and a rigorous review process. But what happens when you've done everything right, presented your case honestly, and the IRS still says no? What recourse do you have when your request for relief is denied? The answer lies in a fundamental taxpayer right, the right to appeal. Before we explore this critical function, let's reaffirm our commitment. This information is for educational purposes only and does not constitute legal or tax advice. The appeals process is a formal, quasi-legal procedure, and navigating it successfully often requires the expertise of a qualified tax professional. The IRS has an independent division called the Office of Appeals. The mission of this office is to resolve tax controversies without going to court, on a basis that is fair and impartial to both the government and the taxpayer. This independence is key. The appeals officer assigned to your case had no involvement in the original decision made by the IRS examiner or collection agent. They are there to provide a fresh, unbiased review of the facts and the law. You generally have the right to appeal most IRS decisions. If the IRS rejects your offer in compromise, denies your request for penalty abatement, turns down your claim for innocent spouse relief, or proposes a wage garnishment or bank levy, you will typically receive a letter. This letter will not only state the IRS's decision, but will also explain your right to appeal that decision. Crucially, it will give you a strict deadline, usually 30 days, to file your appeal. The process begins by filing a formal document called a protest. This isn't simply a letter saying you disagree. A formal protest is a written statement that outlines your position in detail. You must explain the specific points of the IRS's decision that you disagree with, present the facts of your case as you see them, and cite any laws or authorities that support your argument. This is your opportunity to formally make your case and ensure the appeals officer understands your side of the story. Once your protest is received and processed, your case is assigned to an appeals officer. This officer will review your protest, the entire case file from the original IRS division, and any new information you provide. The process from here is typically a conference, which can happen over the phone, via video call, or sometimes in person. This is not a courtroom trial. It is a professional discussion where you or your representative will present your arguments, and the appeals officer will present the government's position. One of the most important aspects of the appeals process is that appeals officers have a level of flexibility that initial examiners do not. They have the authority to consider the hazards of litigation. This is an assessment of the potential risks and costs to the government if the case were to proceed to U.S. tax court. If they believe there's a chance the IRS could lose in court, or that certain parts of the government's case are weak, they have the authority to negotiate and reach a settlement. This allows for middle ground solutions that were not possible during the initial review. After the conference and review, there are a few possible outcomes. The appeals officer may agree with you entirely and overturn the original decision. They may deny your appeal, upholding the original decision. Or, very commonly, you and the appeals officer may reach a settlement or compromise that is somewhere in between. If you still disagree with the final decision from appeals, your next step for most issues would be to petition the U.S. tax court. The appeals process is a critical check and balance within our tax system. It ensures that every taxpayer has the right to have their case heard by an independent party before the IRS takes final action. In our next chapter, we will shift our focus to tax issues that specifically affect business owners, starting with one of the most serious, the trust fund recovery penalty. Welcome back. Thus far, our series has primarily focused on individual tax relief. But now, we turn our attention to the unique and often more complex challenges faced by business owners. If you are an employer with employees, you are responsible for withholding taxes from their paychecks and remitting that money to the government. What happens when a struggling business fails to make those payments? The consequences are severe, and they center around one of the most powerful collection tools the IRS possesses: the Trust Fund Recovery Penalty, or TFRP. Before we unpack this critical topic, we must emphasize our standard disclaimer. This information is for educational purposes and is not a substitute for professional legal or tax advice. The TFRP has profound personal, financial, and legal consequences, and any business owner facing this issue should immediately seek counsel from a qualified tax professional. To understand the TFRP, you must first understand the concept of trust fund taxes. These are the portions of tax that you, the employer, withhold from your employees' paychecks. This includes their share of Social Security and Medicare taxes, as well as the federal income tax withheld. This money never truly belongs to the business. The business is merely acting as a trustee, holding the employee's money in trust with the sole purpose of turning it over to the U.S. Treasury. When a business fails to remit these trust fund taxes, the IRS does not just go after the business entity. They can use the trust fund recovery penalty to personally assess the full amount of the unpaid tax against the individuals who were responsible for collecting and paying it. This is the most crucial aspect of the TFRP. It pierces the corporate veil. It does not matter if your business is a corporation or an LLC designed to protect your personal assets. The IRS can and will bypass that protection and pursue the personal assets of the individuals it deems responsible. So, who does the IRS consider a responsible person? This definition is much broader than you might think. It is not limited to just the owner or the president of the company. A responsible person is anyone who had significant control over the business's finances, and the power to decide which bills were paid and which were not. This could include a CEO, a chief financial officer, a company director, a major stockholder, or even a bookkeeper or office manager if they had check-signing authority and made decisions about payments. To assess the penalty, the IRS must establish two things for each individual: responsibility and willfulness. We've just defined responsibility. Willfulness, in this context, does not mean you had a malicious intent to defraud the government. Willfulness simply means you were aware that the taxes were due, and you knowingly and intentionally paid other creditors instead. Using that trust fund money to pay rent, suppliers, utility bills, or even the next payroll instead of sending it to the IRS is considered a willful act. The process for assessing the TFRP is methodical. An IRS revenue officer will investigate the business to determine who the responsible parties are. This often involves interviews and requiring individuals to complete Form 4180, a detailed questionnaire about their duties and authority within the business. Once the IRS proposes the assessment, the individual has the right to appeal the decision through the IRS Appeals Office, which we discussed in our last chapter. The consequences of being assessed the TFRP are life-altering. The penalty is for 100% of the unpaid trust fund taxes. This debt is notoriously difficult to get rid of. It is generally not dischargeable in bankruptcy. The IRS can use its full array of collection tools, including liens on your home and levies on your personal bank accounts, to collect it. In our next chapter, we will continue our focus on businesses by exploring tax relief options such as the business offer in compromise and other strategies for managing business tax debt. Welcome back. In our last chapter, we confronted the stark reality of the trust fund recovery penalty and the immense personal risk it represents for business owners. Hearing about such severe consequences can be discouraging, but it's crucial to know that when a business falls behind on its taxes, there are structured pathways to resolution. Just as with individual taxpayers, the IRS has programs designed to help businesses manage and resolve their tax liabilities. As we explore these options, please hold on to our foundational rule. This content is for educational and informational purposes only. Business tax law is incredibly complex, and the stakes are high. Navigating these issues without the guidance of an experienced tax professional is strongly discouraged. For a business that has fallen behind but is otherwise viable, the most common solution is a business installment agreement. Similar to the individual agreements we discussed earlier, this allows a business to pay its overdue taxes in monthly installments over an extended period. For smaller payroll tax debts, the IRS even offers a specific program called the In-Business Trust Fund Express Installment Agreement, which can simplify the process. Setting up an agreement allows the business to continue operating without the immediate threat of bank levies or asset seizures. However, there is a non-negotiable rule for any business on a payment plan. You must remain current on all ongoing tax obligations. This is especially true for payroll tax deposits. If a business on an installment agreement misses even a single current payroll tax deposit, the IRS will typically default the agreement immediately and resume aggressive collection actions. The next option is the business offer in compromise. While it operates on the same principles as an individual OIC, settling the debt for less than the full amount, it is significantly more challenging for an operating business to obtain. The IRS's perspective is that they are not in the business of subsidizing a failing enterprise. To approve an OIC for an ongoing business, they must be convinced it's in the government's best financial interest. There are generally two grounds for a business OIC. The first is the familiar doubt as to collectability. The business must prove, through extensive financial documentation, that the total value of its assets plus its projected future income is less than the tax debt owed. The IRS will conduct a deep analysis of the business's cash flow, accounts receivable, inventory, and the liquidation value of its equipment. The second, more nuanced ground is doubt as to collectability with special circumstances. This is sometimes called the effective tax administration argument for businesses. Here, the business might technically have enough assets to pay the debt in full if it were to liquidate everything. However, the argument is that forcing this liquidation would shut the business down, put employees out of work, and ultimately result in the IRS collecting less than they would if they allowed the business to continue operating under the terms of an OIC. This requires a compelling case that the long-term collection potential from a surviving business is greater than the short-term liquidation value. Regardless of the type of relief sought, the process for a business is demanding. It requires meticulous financial records and a clear plan for future compliance. The IRS needs to see that the problems that led to the tax debt in the first place have been resolved. For some businesses in deep financial distress, A Chapter 11 bankruptcy reorganization may also be a viable, though highly complex, legal strategy to manage tax debts and continue operations. In our next chapter, we will address a topic that causes anxiety for individuals and business owners alike: what to do when you receive a notice that you are being audited by the IRS. Welcome back. There are few phrases in the English language that can cause as much immediate anxiety as "you are being audited by the IRS." For many, receiving that official-looking envelope triggers visions of intense interrogations and financial ruin. But while an audit is a serious matter that requires your full attention, it is also a structured, methodical process. The key to navigating it successfully is to be prepared, professional, and to understand your rights. As we begin this important discussion, please remember our most critical guideline. This is an educational overview, not legal or tax advice. If you are selected for an audit, it is highly advisable to seek representation from a qualified tax professional, such as a CPA, an enrolled agent, or a tax attorney. First, let's demystify what an audit actually is. An audit is simply a review or examination of an organization's or individual's accounts and financial information to ensure that information is being reported correctly, according to the tax laws, and to verify the reported amount of tax is correct. The IRS doesn't have the resources to audit every return, so they use a combination of computer screening and human review to select returns that appear to have discrepancies or fall outside of statistical norms. Being selected does not automatically mean you have done anything wrong. There are three main types of audits. The simplest and most common is a correspondence audit. This is handled entirely by mail. The IRS will send you a letter asking for more information or documentation about specific items on your return, such as charitable donations, medical expenses, or business-related deductions. You respond by mailing back the requested records. The next level is an office audit. In this case, you, or your representative, will be asked to visit a local IRS office to meet with an auditor. The audit notice will specify which records you need to bring. These audits are typically focused on a handful of specific issues on your return. The most comprehensive and serious type is the field audit. This is where an IRS agent will visit your home or, more commonly, your place of business. Field audits are usually reserved for more complex returns, often for businesses or high-income individuals, and can cover the entire return, not just a few line items. Regardless of the type of audit, your rights as a taxpayer remain the same. You have the right to professional representation. You have the right to be treated professionally and courteously by IRS employees. And you have the right to know why the IRS is asking for information, how they will use it, and what will happen if you do not provide it. The single most important rule when you are under audit is this: be organized and only provide the specific information that has been requested. Do not volunteer extra information or engage in casual conversation with the auditor about your finances or business. Answer the questions asked, provide the documents requested, and nothing more. This is where a professional representative is invaluable, as they can act as a buffer between you and the auditor, ensuring the process stays focused and professional. Once the audit is complete, the examiner will issue a report with their findings. If they find no issues, you will receive a no-change letter. If they propose changes, you have two options. You can agree with the findings, sign the examination report, and make arrangements to pay any additional tax, penalties, and interest. Or if you disagree, you have the right to appeal the decision, a process we discussed in a previous chapter. An audit is not a pleasant experience, but it does not have to be a catastrophe. With preparation, professionalism, and proper representation, it is a manageable process. In our next chapter, we will discuss a critical concept that governs all tax matters: the statute of limitations. The legal time limits the IRS has to audit you or collect a debt. Welcome back. Throughout our series, we've discussed IRS processes that can feel indefinite and overwhelming. But our tax system is built on a framework of laws, and a cornerstone of that framework is the concept of finality. Even the IRS has deadlines. These deadlines are known as the statute of limitations, and they define the specific time periods the government has to audit your return, assess new tax, and collect a debt. As we unpack this fundamental legal topic, we must stress our most important caution. This is a highly complex area of tax law, and this chapter is for educational purposes only. The dates and timelines can be paused or extended by various actions. Never make a decision based on your own interpretation of a statute of limitations without first consulting a qualified tax professional. Think of the tax world as having three main clocks that are always ticking. The first is the assessment statute of limitations, which you can think of as the audit clock. In general, the IRS has 3 years from the date you file your tax return to assess any additional tax. If you filed your 2023 tax return on April 15, 2024, the IRS generally has until April 15, 2027, to audit that return and assess more tax. However, there are major exceptions to this 3-year rule. If you have substantially understated your gross income, meaning you left out more than 25% of your total income, the clock is extended to 6 years. More importantly, if you file a fraudulent return, or if you fail to file a return at all, the statute of limitations for the IRS to assess tax never expires. This is the most critical takeaway. For fraud or failure to file, there is no time limit. The second clock is the collection statute of limitations. Once the IRS has officially assessed a tax against you, they generally have 10 years to collect that debt. This deadline is known as the collection statute expiration date, or CSED. If the IRS does not collect the full amount within that 10-year window, the debt is legally extinguished, and they can no longer pursue you for it. But this 10-year clock is not always straightforward. Certain actions can toll the statute, which means they pause the clock. For example, when you submit an offer in compromise, the 10-year collection clock stops ticking while the offer is being considered, and for 30 days after. Filing for bankruptcy also pauses the clock. This is a critical feature of the system, designed to prevent taxpayers from using relief programs simply as a way to run out the clock on their debt. The third and final clock is one that belongs to you, the taxpayer. The refund statute of limitations. This is your deadline for claiming a refund for taxes you overpaid. Generally, you must file a claim for a credit or refund within 3 years from the date you filed your original return, or within 2 years from the date you paid the tax, whichever is later. If you miss this deadline, you may forfeit your right to get your own money back, even if you are legitimately owed a refund. Understanding these statutes is fundamental to understanding your rights and obligations within the tax system. They ensure that tax matters have a definitive end and prevent the indefinite threat of audit or collection. In our next chapter, we will address one of the most practical questions of all. When and how should you seek professional help? We'll explore the roles of CPAs, enrolled agents, and tax attorneys. Welcome back. Over the past 13 chapters, we have journeyed through the intricate and often intimidating landscape of the IRS. We've discussed everything from offers in compromise and audits to statutes of limitations. This journey has likely made one thing abundantly clear. While knowledge is power, navigating this system alone can be a monumental task. This brings us to perhaps the most practical and important question of the entire series. Who can you trust to help you? Before we introduce the key players, we must deliver our final, crucial disclaimer. This chapter provides a general overview of different professional credentials and is for educational purposes only. It is not an endorsement of any individual or professional type. The act of choosing a representative is a significant personal and financial decision that you should make only after careful research and due diligence. When you're facing a serious tax problem, you need a qualified expert with the legal authority to represent you before the IRS. There are 3 main types of professionals with unlimited practice rights, meaning they can represent any client on any tax matter. They are enrolled agents, certified public accountants, and tax attorneys. Let's start with the enrolled agent, or EA. EAs are tax specialists. They are licensed directly by the U.S. Department of the Treasury after passing a comprehensive 3-part examination covering all aspects of the tax code. Because their license comes from the federal government, an EA can represent taxpayers in any state. Think of an enrolled agent as a specialist, much like a cardiologist who focuses only on the heart. Their entire professional world revolves around tax preparation, tax planning, and representing clients before the IRS. Next are certified public accountants, or CPAs. CPAs are licensed by their respective state boards of accountancy. While many CPAs specialize in tax and are excellent representatives, the CPA credential itself is broader. It covers areas like financial auditing, business consulting, and financial planning. A CPA with a strong tax focus brings a wide range of financial expertise to the table. They are like a trusted family doctor of finance who has deep knowledge of the entire financial system, including the complexities of tax law. Finally, we have the tax attorney. A tax attorney is a lawyer, licensed by a state bar, who specializes in tax law. You absolutely need a tax attorney if your case is headed to U.S. tax court, or if there is a risk of criminal investigation. A tax attorney's key advantage is the attorney-client privilege, which provides a level of confidentiality in your communications that other professionals cannot offer. They are the surgeons of the tax world, essential for the most legally complex and high-stakes situations. So how do you choose? The right professional depends entirely on your specific situation. For a complex collection case or audit representation, a seasoned EA or CPA is often a perfect fit. If the IRS is accusing you of fraud or you need to litigate a matter in court, a tax attorney is non-negotiable. When vetting a potential representative, always verify their credentials. You can check the license of an attorney with the State Bar, a CPA with the State Board of Accountancy, and you can verify all 3 types of professionals in the IRS's online directory. Be wary of anyone who guarantees a specific outcome, such as promising your offer in compromise will be accepted. A true professional will only promise to represent you diligently and competently. In our final chapter, we will bring everything together, summarizing the key principles of tax resolution, and offering some final thoughts on moving forward with confidence. Welcome back for the final chapter of our series, an honest look at IRS tax forgiveness programs. Over the past 14 chapters, we have journeyed deep into the world of IRS tax relief. We've demystified complex programs, defined technical terms, and explored the structured processes that govern our tax system. Our goal was to replace the fear and uncertainty that often surround tax debt with knowledge and clarity. In this concluding chapter, we will distill everything we've learned into a few core principles to guide you on your path to financial recovery. Our series began with a simple question: are tax forgiveness programs real? We learned that the answer is a nuanced yes. The myth of a magical, effortless erasure of debt is false. But the reality of legitimate, legally established tax relief programs for those in genuine need is very true. These programs are not loopholes. They are safety nets built into the law. As you move forward, holding on to the following principles will be your most valuable asset. Principle number 1. Do not ignore the problem. This is the most important rule of all. Unopened letters and unanswered phone calls do not make a tax debt disappear. They only make it worse by allowing penalties and interest to grow, and by limiting your future options. The single most powerful step you can take is to face the problem head-on. Open your mail. Understand the notices. Acknowledging the problem is the first step to solving it. Principle number 2. Compliance is the foundation. We saw this theme repeated in nearly every chapter. To qualify for almost any form of tax relief, be it an offer in compromise, an installment agreement, or even currently not collectible status, you must be in compliance with your current tax obligations. This means having all your required tax returns filed. You cannot ask the IRS to help you with old debts if you are not meeting your current responsibilities. Principle number 3. Resolution is a process. Resolving a significant tax issue is not a quick fix. It is a methodical process that requires patience, organization, and complete transparency. It involves gathering documents, completing detailed financial statements, and communicating professionally with the IRS over a period of many months, or even years.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Understanding this from the outset can help manage expectations and reduce frustration. Principle number 4. Know that options exist. Throughout this series, we have explored a toolkit of potential solutions. The offer in compromise for those who truly cannot pay their debt in full. The installment agreement for those who can pay over time. Currently not collectible status for those in temporary hardship. Penalty abatement for those with a valid reason for their compliance lapse. And innocent spouse relief for those unfairly burdened by a partner's actions. Knowing that these different options exist is the first step toward finding the one that fits your situation. Principle number 5. You have rights. The tax system is not a one-way street. You have the right to be treated professionally, the right to privacy and confidentiality, and as we discussed, the right to appeal an IRS decision. Most importantly, you have the right to professional representation. This leads to our final principle. Seeking professional help is a sign of strength. You would not perform surgery on yourself. You should not try to navigate a complex tax controversy alone. A qualified, credentialed tax professional, an enrolled agent, a CPA, or a tax attorney, is your advocate, your guide, and your expert. They can speak the IRS's language, protect your rights, and develop a strategy that gives you the best possible chance for a favorable outcome. The journey out of tax debt can feel long, but it is a journey that millions have successfully made. By embracing communication, ensuring compliance, and seeking professional guidance, you can transform anxiety into action and uncertainty into a clear plan. We hope this series has empowered you with the knowledge to take that first crucial step. Thank you for joining us. Remember, this series was for educational purposes. Please consult a qualified professional for advice on your specific situation. Welcome back. We had originally planned to conclude our series in the last chapter, but we felt there was one more vital topic to cover. After spending so much time discussing how to solve tax problems, it's only fitting that we dedicate our final chapter to the most effective solution of all: prevention. This chapter is about building the habits and systems that will help ensure you never find yourself in a stressful tax situation again. As we embark on this final piece of advice, please consider our familiar, yet crucial, disclaimer. This information is for educational purposes only. It is designed to provide you with general knowledge to help you manage your financial life. For advice tailored to your unique circumstances, please consult with a qualified tax professional. Preventing tax problems isn't about mastering the entire tax code. It's about mastering a few fundamental habits. First, master your withholding. If you are an employee, the single biggest source of tax trouble is incorrect withholding. The Form W, for you fill out with your employer, determines how much tax is taken out of each paycheck. If you withhold too little, you'll be hit with a large, unexpected bill and potentially underpayment penalties when you file. We recommend using the IRS's official tax withholding estimator tool online at least once a year, and especially after any major life event, getting married, having a child, or starting a new job. The goal is to pay your taxes as you go, ensuring that what you owe at the end of the year is a small, manageable amount, or even a refund. Second, conquer estimated taxes. If you are self-employed, a freelancer, or a gig worker, this is for you. You do not have an employer withholding taxes for you. You are your own employer. You are required to pay your income and self-employment taxes to the IRS in 4 quarterly installments throughout the year. The biggest mistake new entrepreneurs make is treating all their revenue as income. A winning habit is to create a separate bank account and immediately transfer a percentage, say 25 to 35%, of every single payment you receive into that account. That is your tax account. It is not your money, it belongs to the government. This discipline prevents the shock of a massive tax bill and ensures the funds are there when your quarterly payments are due. Third, embrace good record keeping. This habit is your best defense in an audit and the key to maximizing your legal deductions. You don't need a complex accounting system. It can be as simple as a set of labeled folders for receipts, or using a modern app to scan and categorize your expenses as they happen. For business owners, it is absolutely critical to maintain a separate bank account and credit card for your business. Commingling personal and business funds is a recipe for confusion and can lead to disallowed deductions. Finally, face financial trouble proactively. Life happens. A major client might pay late, or an unexpected expense can drain your resources. If you find yourself in a position where you cannot pay the tax you owe, do not hide. Remember the lessons from our series. The failure to file penalty is typically much more severe than the failure to pay penalty. Always file your tax return on time, even if you cannot pay the full amount. Then, immediately be proactive. Contact the IRS or your tax professional to set up an installment agreement. Being proactive shows the IRS you are acting in good faith and can prevent the problem from spiraling into liens, levies, and a decade of financial stress. These habits, managing your withholding, planning for estimated taxes, keeping good records, and facing problems head-on, are the foundations of financial peace of mind. They are not chores. They are acts of control over your own financial destiny. Thank you for joining us on this extensive journey through the world of IRS tax relief. We hope this series has left you feeling not just informed, but truly empowered.
Disclaimer: this video is for informational and educational purposes only, and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.